The S&P 500 just hit a new record high, and gold is struggling. We're speaking with Vince Lanci. He's a fund manager and the publisher of the Goldfix newsletter today, and a first-time guest on the program. And I'm really looking forward to catching up with him, as it seems like we're seeing peace in the Middle East, and the gold price is under pressure because of it, perhaps. We'll talk about that. Before I switch over to my guest, hit that like and subscribe button. It helps us out tremendously. It's a free way to support our channel. Thank you so much for doing that. Now, Vince, it is a great pleasure to have you on the program. Welcome to Soar Financially.
Thank you for having me, and I appreciate coming on this program. I've heard a lot about it. I only wish you had called me earlier when gold was on the way up, but we'll have to deal with it.
Well, we'll figure out where it's trending now. You're setting a very negative tone already, Vince. I don't like that. We gotta stay positive.
I'm very bullish.
We have to stay positive here. But Vince, maybe we'll start setting the scene a little bit at first. Like, what is the current environment that you're seeing out there before we get into some of the specifics that we've sort of discussed, like gold repatriation, geopolitics? Like, what is your general assessment at first?
Just putting everything that you want to discuss, and we will discuss under that umbrella. I think gold has had a run starting in December 23, but getting going in March 24. And the market is repricing gold for multiple reasons, but the primary reason is central banks have become buyers looking to de-dollarize their assets. And the de-dollarization, while it has been going on for a while, will continue to go on until they get about 30% of their assets into gold as a hedge against the growing influence of the BRICS, as a hedge against geopolitical risk, and as a return to a more mercantilist type of world where globalization just goes away. And I know that you're seeing that in Europe, and we're seeing it from afar, but we're also seeing it. So gold's not going to have any natural selling or swoons lower until the geopolitical, the trade issues all get resolved with a little more finality.
No, as we discussed, Vince, lots going on, and geopolitics. Let's start there, because I think that's the biggest topic that's pulling on gold or moving gold right now, has the most price effect. It seems like the Middle East is coming to, or the war in the Middle East is slowly coming to an end. Peace agreements, Israel and Gaza are seemingly coming to an end here. Hamas, willing to agree to a deal with Israel, and all brokered by the U.S. Gold is down 1.6% as we're speaking, so it seems like the geopolitical balloon is deflating here. What do you make of that, Vince? And where will it take gold in that respect?
Okay, you're absolutely right. The urgency of buying gold is being pulled out of the market. So the fundamentals, which means the de-dollarization of the world, is not going away. But the urgency to do that and the fear is subsiding. Just to paraphrase something Goldman Sachs had said, the genie from confiscating Russian wealth after the 22 invasion of Ukraine is not something that can be put back in the bottle. And not being able to do that, once we've done it to them, we could do it to everyone. And so at that point, you have a geopolitical, reason to not own gold. Then you have the BRICS, which is also geopolitical, but it's trade related. And they're saying, we don't want to use dollars. We don't trust dollars for different reasons. And we want to own gold. And the BRICS partners, China is the BRICS when I think of the BRICS. But the thing that really got us going, to your point, was the kinetic aspect of the wars that we're having, kind of like a fragmented world war. There's an Eastern Front in Israel, and there's a Western Front in the Ukraine now. But the urgency has backed off. And it's backed off because I think we're at peak tariff, right? We're at peak tariff, knock on wood. Trump is behind the scenes cobbling a Plaza 2.0 type of deal to weaken the dollar. And to the main point is, it seems that while he's doing that, for whatever reason, there's a little bit of peace breaking out in the war-torn parts of the world. And I find it interesting, just to give a little color on that without going too far down a rabbit hole. Note that Trump went to Riyadh and cut a deal with the Saudis. And then he went to China and cut a deal for rare earths. And then Israel attacked Iran. And it's almost like it was a geopolitical tie-in. We're going to work on the trade. We're going to keep the Saudis on board as an investor in the U.S. We're going to hopefully slow them from de-dollarizing their oil sales. And then we're going to kind of let Israel off the leash. And Israel's off the leash. And now it's not just the U.S. protecting the Middle East from Iran or protecting Israel from Iran. You're also protecting Iran from Israel. And I think that's why you're having this escalation to de-escalate. And I thought that's what I called it the first night it happened. And I saw it happening. And those are reasons to not own gold anymore. You know, I think there are reasons to not own gold, and they're based on a cooling of the tariffs, tariff rhetoric anyway, progressive movement towards the war ending in the Middle East. I'm not sure about the Ukraine-German situation, the Ukraine-Russian situation. I know Germany's like, right on the for that. If you're Poland or Germany, you're looking at that going, we don't really want to have to deal with this again. And then I look at the central bank situation where they're buying it. And so everyone is basically still buying, but they've lowered their bids. And that's made all the speculators who front run the fundamental buying sell off. So, I mean, that might not be too helpful, but I'm just trying to touch all the bases before we get specific.
No, it is very helpful because, like I mentioned to you before, being a podcast host these days is extremely difficult because there's just not one topic to talk about. There's
Right.
so many strings to pull on, and I think we'll need to focus just on the most important ones, and I'll let you choose which is the most important one right now for you there, Vince.
Oh, well, the current events is the geopolitics, right? I think the current event is the geopolitics. The upcoming events are Basel III, and I think the in the wings waiting to become a problem is the gold repatriation concerns that are rising in Europe, and some for good reasons, some perhaps not for good reasons. But I mean, if you're asking me to decide, I recently put out a post, a couple of days ago I put out a post, and I said this: geopolitics will not be the upside driver for gold for the rest of the year. The upside driver for gold for the rest of the year will be if it comes U.S. rate cuts. I don't know that it's going to continue. I don't know that Powell's going to do that, but I do believe that as the geopolitical situation eases, the gold bids will lower and be more patient. And as that happens, you're going to have people starting to get short and sell precious metals again because it's no longer a geopolitical hedge. You may have up to $500 in that market. But here's the thing: no one wants to sell it because as we come out of these wars, Europe has been cutting rates constantly, right? The Swiss are going ZERP and possibly NERP. Is it NERP? I know some of the bonds are negative over there already. And you're looking at a need to respend and rebuild in Ukraine and Israel and Gaza and Iran. And even though those things are inflationary as a gold bug, I think people are going to say we'll stomach the inflation and we'll spend the money anyway. And so the macroeconomic drivers of gold will take the front seat for gold going higher, while the geopolitical drivers are working against gold. So that's broadly how I'm looking at it.
Vince, I was just looking at the gold price here on my other screen, and the attack on Israel by Hamas happened October 7th. Gold was around $1,900 back then. Now we're at 33 or 32.75 here as we speak. Where do you think gold will head if the air gets left out of that geopolitical balloon here?
Well, I mean, there's the unrealistic air letting out the geopolitical balloon, and there's the realistic air. I'm not much on targets, but I do think, like if just speaking about the unrealistic one for a second, unrealistically, let's make all the geopolitics go away. You ready? Trump has a conversation with Putin, and he says, "We're going to give you your money back." right? That's an unconfiscation of wealth, right? Russia also pulls out of Ukraine completely, right? The unrealistic version. And in the Middle East, Iran completely goes back to, not goes back to, not if they ever were, is completely transparent about their nuclear program and asks for aid from the West in return for transparency. If those things happen, well, it's not going to stop de-dollarization. It's going to slow it. What could happen to gold? To give you like an idea, you referenced the beginning of the Israel-Gaza problem, which was October 7th. And that was an incredibly important date because after that happened, we had a series of different problems that kept taking gold higher. So you had the just going back 1 second chronologically, gold peaked during the invasion of Ukraine. And then it was driven lower by the US Fed finally raising rates to fight inflation. And then it had a trough and October 7th started and it took off again. So now let's take away that. Let's pretend it never happened. You still have, this is the macro part, you still have between October 7th and now, you had banking crisis in the US, SVB went under, right? So you have the fear of banking being insolvent. And I believe many banks in Europe are insolvent. They may be liquid, but they're not solvent. So that's not going to go away. That's a macro issue. You have the deficit problem. As the rest of the world is adding deficit now, Europe needs to rebuild, Japan needs to add to their defenses, everyone needs to spend money because America's not spending as much money, depending on how you look at it. The U.S. has to go more frugal, or our deficit's going to be a global problem. And we're not going more frugal. I don't care what Trump says or what he's trying to do. It's not going to make a dent. And we're going to monetize our debt and it'll get worse. So between October 7th, 2023 and now, you had maybe 5 events that added $200 to gold. So that's $1,000. Take 3 of them away and gold tops $500. But I don't see it happening. And that's because, and this is the key for me tactically, the bullion banks got obliterated playing from the short side. And that chicken came home to roost, so to speak, when the U.S. repatriated a lot of its own gold. So I don't see more than $350 to the downside in gold. The upside, I think, is also quite limited. Not quite limited, but limited. I think $3,700 by the end of the year is not unrealistic, but I don't think it will happen in the powerful, exciting way that it has. So those are my targets, if you want to call it that.
No, I appreciate that. Like, it's very clear. Because as you said, we've seen a lot of macro shocks that weighed on the gold price. So it's good to get some perspective around them and how you sort of frame that as well. You touched on a couple of things that I just need to follow up on with you here, Vincent. One is the inflation expectations, of course. Curious what your thoughts are on inflation are in the U.S. in general, maybe global inflation as well. But what are your thoughts, and how is gold playing a role in that calculation here?
Well, in the inflationary situation in the U.S., there are 2 schools of thought. One school of thought is using tariffs, right? So we're coming out of an inflationary cycle. Powell is getting his way, but there are 2 schools of thoughts, and they center around tariffs. And one school of thought is tariffs are inflationary. The other school of thought is tariffs kill demand, at least in the U.S. And despite the fears of inflation, overblown fears of inflation at 7 or 8%, depending on what poll you're looking at in the U.S., that has not manifested. So for the last 6 months of tariff concerns and tariff, implementation, for lack of a better word, I don't even know if they're really implemented yet. U.S. demand has decreased. And so that has been a headwind to inflation resurging. I think going forward, you're looking at a situation where the tariffs will, on the back end, start to be inflationary. And I want to tie this in with Jerome Powell. right? Because this all ties together at the macro level. Because, and I'm gonna be an advocate for Powell before I, say I'm not an advocate. Powell's claim, Powell's claim is he doesn't want to lower rates now because of uncertainty surrounding tariffs. Now, political, nonsense aside, because he's got a problem with Trump. What he's legitimately saying is, I don't want to lower rates and give people fuel to go out and feel that they can just spend money and then the tariffs become inflationary. He actually wants the corporations on some subconscious level to eat the tariff losses. Now, the reason, and this actually comes back to Europe, the reason that his concern is warranted is because you may remember about, 2 months ago, he lowers rates, or he had lowered rates. And the short-term part of the bond market, yields were dropping, and the dollar was dropping, and long-term yields were going up. And you saw this cry come out of mostly Europe, that the U.S. is losing its safe haven status in general, meaning the dollar's getting weaker and stocks are dropping. Okay, I can handle that, but bonds should be getting stronger, and they were not. And so the hue and cry was, hey, there's no way Powell can cut rates, because if he does, then the U.S. has its own Liz Truss moment, right? Fiscal slop with monetary easing means inflation is going to come back. And I think the moment Powell does cut, you're going to see that happen. The question is, how bad will it be? And I think what he's trying to do right now is keep the inflation under control. I think what he's probably going to do is keep the inflation under control too long. The U.S. will go into an official recession. And then the next Fed chair will come in like an Arthur Burns and just cut rates 50 or 100 basis points. And then we're off to the races, 1977 style. That's what I think. And that'll be good for gold.
Now, it's an interesting debate, of course. Like, I had guests on that said, well, don't worry about inflation. It's just, or the tariffs, they're disinflationary. Others are saying very strongly, it's like, no, they're inflationary. They just haven't shown up yet. All right. So maybe to follow up on that, Vince, like, do you think inflation will peak, or no, sorry, not peak, will start to increase now with the June and July CPI data that we're seeing?
I don't have a strong opinion on it. I haven't studied it, but the consensus coming out of people who are at that pay grade, they were saying that we think the inflation from tariffs it won't be as big as everyone feared, right? Because we had these tailwinds knocking inflation down. You're going to see inflation start to go up. In fact, we saw it today. The inflation is basically bottoming and upticking a little bit. As long as it doesn't uptick too violently, I think Powell will wait for that to clear and then ease, probably September or October or November, I should say. So I think to answer your question pointedly is that there's nuance here. We're in a disinflationary environment. Powell doesn't want to cut because he's worried about tariffs. Tariff risk seems to be decreasing, while the first leg of tariff implications has been a decrease in demand. He's going to cut rates when he thinks things are fine. And this is why the Middle East war was big. Had the Middle East war gone on, the geopolitical impact on oil would have made Powell unable to cut it all. So I think given the choice between inflation resurging or recession manifesting, I'm coming down slightly on the side of recession manifesting right now in the U.S.
The tariff pause ends July 9th, and so far, at least, it's June 27th as we're recording this here. I haven't heard anything, or not much, out of the EU or China, for that matter, besides the meeting in London 2 weeks ago or so now, that has me positive that it'll be resolved. What is your opinion on that, and how much turmoil can we expect based on experience over the last 6 months here?
That's the wild card is Donald Trump. Right, and I'll come back to why he's a wild card in a second. Other than how he likes to push on walls to see what's given. I think the tariffs are now fully priced out, which means, this is like me thinking out loud, the tariffs are now fully priced out of gold. The geopolitics is fully priced out of gold. I believe that the geopolitics are priced out of gold as much as they will be. The tariffs, which really is a deal being cut with China, are beginning to be priced into gold. So stocks are going up, at least in the US, on a hope that that will resolve itself. And gold is lagging in selling off, but it's beginning to tumble as we saw today. And I think, and this is why this is on my radar now, Kai. I'm glad you brought it up. I think the market is close to under handicapping the volatility that will come on July 9th. I mean, I'm not going to sound a panic button yet, but I'm going to say that there's more downside for gold before there is upside. Like I would say to you, if July 9th comes and there is no deal, that's $100 higher for gold. But I think the chances of a July 9th, they're not going to resolve everything July 9th. How's this? Trump, right? They're going to extend the ceasefire, which is what politicians do. And so to the extent that the market will buy into it, I think gold will not rally. I mean, what's the news out today or yesterday? Trump says he has a signed deal with China. I can't tell if we're on a world stage in the US or we're in like a little bubble, almost like you're in an authoritarian country. Meaning like China, what China says, we just go, you're just speaking to the home crowd. I can't tell if Trump is speaking to the world or to the home crowd anymore. And so that volatility has to be in there. However, I do sense, and I think this is the personal aspect of Trump's volatility. Once the US midterms are over, if he doesn't have the things in place he wants to have in place, he's done as a lame duck politically. And so I think he really does care about his legacy, and he wants to broker this trade deal ceasefire for an extended period of time. I guess I'm a long way from saying I'm not bullish until July 9th comes. There is no extension of the ceasefire. And, you know, I'm happy to be late to that rally because I think there's going to be selling on the way up. But that's a tactical comment. Does that help a little bit?
Yeah, absolutely. Maybe just to combine what we discussed here, Vince, and maybe a bit of speculation. Of course, we can get our crystal balls out, rub them, and see what comes out. But July 9th, let's assume we get a tariff truce. And, you know, China and the U.S. and U.S. and Europe make up, or they come to an agreement. What does Powell do in about 33 days then?
Oh, my God.
That's a tough one, because personally, that's my opinion. If there's a truce and that's all figured out, he's got some hard data that he can use to make a proper decision, right? Yeah. And if it's lower than 30% on China, then I'm guessing cut here, and the market is already expecting 20% of a cut here.
Right. I mean, just to game out what you're saying, like it's actually scary, because if there's a truce on tariffs, then that's going to increase productivity, increase demand, increase trade. So why would Powell cut? Right? But I can give you the knife how to cut that conversation. I've been studying some of the transcripts and some of the Fed meeting notes, and here's where I come down on it. And I'm not alone in this. I think people, I think some bank desks have been saying this. When you're trying to decide between tariffs, being inflation, when you're trying to decide between cut or no cut, let's put it that way, right? Cut or no cut, tariffs or no tariffs, all these little factors. I think this is me and other people, I think, with higher pay grades than me. It comes down to the U.S. unemployment. So Powell has a good handle on the inflation. He sees what can make it go up, and so far that hasn't happened. He's probably extrapolating it going up a little bit, but oil has again helped him. I think the bottom line for him now is unemployment. As long as unemployment does not uptick violently to some number, I don't know what it is, he's not going to cut. So if July 9th comes and there is a truce and U.S. unemployment has just had another uptick, which is going to come next week, then he's more likely to cut. I really think that employment. Look, he's got a double mandate, right? At least on paper, right? One mandate is get inflation down. The glide path for inflation seems good now. The glide path for unemployment seems to be the concern. So if tariffs don't get kicked down the road, unemployment's going to go up and he's going to have to cut. It's unenviable to be that man.
No, I don't want to have that job, quite honestly. It's already difficult enough being a podcast host, trying to make sense of it all, quite honestly. Vince, but moving on, we have a couple more big topics we need to tackle. One of them is Basel III, and you promised me that you're finally the guy who can actually answer my questions about Basel III and the impact on the gold price. What is priced into gold, and what does it actually mean? Help us understand what the effect on gold is.
Basel III, so we'll do like the lightning round version, right? So Basel III is European in design as influenced by American regulators. Basel III's main purpose is to make banks more liquid, to guarantee their liquidity, and to assure that there'll be no more failures. In the US, that centers a lot around treasury liquidity. And you'll notice, just before we get to gold, that yesterday, the U.S. changed the SLR rules, liquidity rules, making it easier for U.S. banks to be liquid. So basically, they lowered their reserve requirements. Now, gold is a small piece of the Basel III situation, but it's incredibly important, and it is the focus of my world. Now, there's the I'm going to give you the conventional wisdom right now, and it's not wrong. The conventional wisdom is, I'm going to lay it out for you. Basel III has made gold a tier 1 capital, which means it can be fully used on a bank's balance sheet, thereby making them more liquid, making them able to not have any solvency problems. And that's one of the drivers behind gold going up. Does it mean that gold's going to be used as collateral in deals? No. And this is, Basel III is bullish for gold, and that's been in the market. That ship has sailed. That's been in the market for over a year. But now going forward, we're now at a line of demarcation where not only is it not a big deal for gold based on some other things that I'm basically a little bit ahead of the curve on this, I think. But Europe and the US have agreed to not implement Basel III as they said they have, though that's going to be kicked down the road as well. So some of your listeners may remember during the Grexit crisis, Basel III was supposed to be launched after Grexit, and it didn't happen because the banks were insolvent. Now Europe has made some statements. The ECB made a statement that we're going to delay our own rollout of Basel III funding requirement rules because we're not so sure that we're on the same page with the US. The US may not be ready to. And I went, well, then they're just going to kick the whole thing down the road again. So I'm not saying it's a nothing burger. I'm saying that to your audience, Basel III as a driver, a bullish driver of gold is already in the market. So going forward, that makes gold a tier 1 asset, which means in the past, I have a bar of gold. I need to get some capital. I show it to the Fed or the ECB, and I say, what can I get for this $1,000 of gold? And they say, well, we'll give you $500. You're like, well, shit, I'll just go and sell it and get the $1,000, right? And that's why gold always tumbled eventually. Now it's like I have a bar of gold. It's worth $1,000 or $3,000, $3,300. And I go to the window and I go, how much can I get for this? And the Fed says, $3,300. Great, I don't have to sell it. So there's less organic selling from central banks in panic. And so that will raise the floor continually for gold for years. However, tier 1 capital does not allow them to go out and trade it more. It just allows them to have a piggy bank that they'll never, ever crack anymore. So gold will rise as a result of that, but only if the powers that be let it be implemented. So the definitive answer for Basel III is it's bullish for gold. It's already in the market. And now the risk is that it gets delayed in implementation again, which would be short-term bearish for gold. That's the bottom line.
maybe just for my understanding, Vince, I really appreciate the explanation here, but do you see any physical gold move into the bank vaults, or do they need to acquire more of it, or is that all priced in? Has that happened already?
Well, yeah. Well, one of the manifestations that I think you can see over the last year and a half was it manifested in multiple ways, but it all comes down to this. There were too many future shorts against not enough gold collateral. So you had it's fractional reserve banking at the bullion side, right? And this is going to dovetail into the repatriation and the LBMA crisis. So you're funneling this right to where it's going to go. Basel III said, we do not want you, the government saying to the banks, we do not want you to have paper gold longs. We want you to have physical gold longs without any shorts hedged against it. And the banks started to do that. And in doing that, simultaneously, China said, you know what? We don't want treasuries, we want gold. And so all the collateral in the world, the gold all over the place, the global gold that was oversubscribed to, you have a bar of gold, I'm going to short it, he's going to short it, he's going to short it, trillions of dollars tied to billions of dollars. Well, those shorts got unwound over the last 3 years. And so you've seen gradually the open interest on the COMEX shrink and shrink and shrink as shorts kept getting slowly and gradually squeezed. So the first manifestation happened over the last year and a half. And that was the futures volume, the futures open interest shrinking as shorts started having to cover. I call it like this. It's a game of musical chairs, and the chairs are the physical gold. And every time someone says, I want this chair, you can't get a seat to park your shorts in. And so it became a scramble. And that scramble peaked with the LBMA kind of getting, I can't believe it, but they were blindsided. You had the LBMA, right, saying, we have all the gold in the world. And then the U.S. saying, fine, we want ours back, whoever it was in the U.S. And we take it back, and they're like, well, we don't have it ready. Can you give us 90 days? And so there were too many. Look, it's like a scene from It's a Wonderful Life where there's a bank run. It was a bullion bank run, which brings us to the repatriation concept. It started with China. It started with Russia, actually, after 2014. Then it went to China. And now Western countries, specifically the U.S., say we want our gold back. Now, mind you, that's because the U.S. probably didn't have all the gold it was supposed to have to begin with. But now that fever is spreading. And so the repatriation of gold is something that's going to go into other G7 countries. And I think you're going to see more and more of that, which puts another floor, a higher floor underneath it. Physical gold is in short supply right now because people actually want their gold. It's almost like you're in a schoolyard and recess is over and everyone's taking their ball and going home. It's like, where you have my ball, give me it back. And so there's a lot of deglobalization manifesting with the fight over good collateral, and that's gold.
Gary Savage said on our program that gold finally broke the cartel. It sounds like to me what you're saying, like, okay, we're getting rid of the short contracts on physical gold, or we're trying to abolish it. Is that sort of what he meant by that? Like, I'm not trying to put words in your mouth or in his mouth, trying to reinterpret what he's saying. Like, so he said he broke the gold broke the cartel because gold just was allowed to run all of a sudden. Like, based on what you're saying, I'm making the interpretation of what he said is that exactly what that is, that Basel III is sort of breaking the cartel by giving gold tier 1 status. Now, I'm curious, maybe as an extension of that, and maybe to throw an extra, extra fuel to the fire, if we add silver to the mix here and make silver a tier 1 asset, where would silver be in that regard?
Right. Okay. So let me start with the end. Silver will never be a tier 1 asset.
Okay.
And strong word to use, never. But if it's a tier 1 asset, I'll be a billionaire. And that's not because I'm long it, but because it's idiotic to use a metal, even though it's monetary as a tier 1 asset. If you're a central bank, that can be squeezed for industrial purposes. So silver will not be, unofficially, oh yeah, they're buying the shit out of it right now. But to the point about the LBMA banks being broken, I have a disdain for bureaucracy. So the LBMA banks, the bullion banks in general, or the LBMA, not necessarily the banks individually, you go bank by bank and say good, bad, good, bad. But the LBMA in general has seen this coming for years and continued to kick the problem down the road. The problem being the lack of transparency in the LBMA over-the-counter operations, that's how they're designed to be. The lack of transparency and the poor regulatory oversight by the LBMA regulators has led to an abuse of a franchise that overstayed its welcome. So the LBMA was allowed to keep kicking their can down the road, to use another idiom. And in doing so, they kind of were waiting to be bailed out by someone else. And Basel III, Basel III was started in 2009 after the U.S. great financial crisis. And in 2011, during Brexit, they delayed it again. By the way, they delayed it right before gold made its high in 2011. And then they delayed it in 2014. And then they delayed it in 2020. When I mean delayed, I mean it was supposed to be fully rolled out. They would pull back what they were going to roll out. Delayed in 2020 because of COVID. And it's probably going to be delayed again because of the tariff war, or at least part of it. So it's never been fully rolled out. And if you're a trader, an opportunistic mindset at a bank, and you're short, exaggerating, 1 billion contracts against 1 million ounces, well, you're thankful every time you get bailed out and you continue operating business as usual. And that's what happens. So was the to bring to your point, was the LBMA broken? I think the LBMA was revealed to be naked short precious metals, and only the intervention by the Bank of England and the other big players on the sidelines saying, okay, we're going to work to not have this. This was a major problem, and it went largely unnoticed because I believe the LBMA members, at least one of them, was completely insolvent, and that LBMA member had private dealings with other LBMA members. So, for example, there's 5 guys in a room. That's your dealers, your dealing banks, and they face the world and they deliver and take delivery of gold. But they also have credit with each other. So it's like a default. Like, picture Europe. Greece is the weakest player back in Brexit, and it could have taken down the whole euro. Well, the weakest bank in the LBMA goes under. Well, the whole structure goes under. And so I believe that, and I have evidence to this effect, I believe that when gold was making its highs for about a 4-month period, while the U.S. was repatriating gold or bringing gold back or whatever you want to call it, the LBMA was kaput. And they were bailed out by the ECB and the Bank of England and the U.S. Fed and the BIS going in and saying, we're going to stop things. And so what they did was, they've done this in the past in many markets. They went out and they said, the bullion banks that are short must cover, and the funds that are long must sell. And so what happened is gold rallied $400, give or take, as the bullion banks covered. They were squeezed out of the market. So now they're at an operationally formidable environment again, but they're scared to death. And it was. I mean, to borrow the Buffett analogy of when the tide goes out, the tide went out in the form of the U.S. calling its gold back, and the LBMA was naked. Some of them were very naked underneath that tide, and I would say that it's lost its legitimacy as a venue for gold, and they must reinvent themselves if they wish to have anything left. The SGE, the Shanghai Financial Exchange, Futures Exchange, everything that's going on out there, it tells you that the COMEX and the LBMA are the old shopping mall, and the new shopping mall is over there. So yeah, I believe it's a slow, painful death now, but not a headline.
Really, really interesting insights there, Vince. And I'm almost sad to ask you my final question here, but we need to talk about the next couple of months. What are your expectations in 60 seconds or less here for the summer?
Seasonality matters here. Seasonally, if nothing were going on, I'd say gold would go higher and drift higher to the middle of September and then have a wicked sell-off between September and November, only to be bought again. Now, that's based on flows and historical seasonal assessments. The difference between now and then is I think the rally this summer will not happen because I think there's still some geopolitical players out there that are looking to get short the market. And as long as oil stays down and the geopolitics stays underwater, I think gold will stay muted. That said, I'm long gold genetically. I'm long silver speculatively, and I just closed the platinum long. So I think I have a good handle on what's going on right now. And I won't be surprised if gold's trading here 3 months from now on the way to 3,700.
Fantastic. Vince, really enjoyed the conversation. We'll have to get you back after the summer because there are so many other topics we need to talk about. The gold vaults that China is setting up, for example. Like, what does it mean? Is it a direct attack on the current money system? Things like that we can expand on, of course. Vince, I really appreciate it. Like, where can we send our audience to follow more of your work?
Well, I think the best, if you're interested in this type of conversation, I think you want to get me at Goldfix Substack or VBL, Victor Boy Larry, Goldfix.substack. We have free and premium subscriptions there. If you're interested in mixed type of posting, you can find me on Twitter under VBL's Ghost. You look that up and you can find me, but it's not for the faint-hearted.
Fantastic, Vince. Really appreciate it. Thanks so much for coming on. Have a great weekend, and we'll talk very soon. Much appreciated, and everybody else, thanks so much for tuning in to Soar Financially. Really curious to hear your thoughts. What is happening to gold once there is peace in the Middle East? Once Israel and Gaza, or Hamas and Palestine sort of sign a peace deal? What happens if the U.S. and Iran sign a nuclear deal next week? Really curious what your thoughts are on that topic. It's a big piece of conversation. So please let us know. And if you haven't done so, hit that subscribe button as well. It's a free way to support us. We tremendously appreciate it because we bring phenomenal guests on, I think. And that's one way to show some appreciation. Thanks so much for doing that. Have a great weekend. We'll be back with lots more. Take care out there.